Microsoft stock is selling off. In the past month alone, the company is now down around 12.55%. About a month ago, they were trading as high as $460 per share, and now they're all the way down to about $406.27 per share. So a pretty decent drop in their share price. Now, a lot of this has to do with the recent earnings report. What's interesting about this is they actually saw beats on the top and bottom lines. Q4 GAAP earnings per share came in at $2.95, which was a beat by around 2 cents, and revenue came in at $64.7 billion, which is up 15.1% year over year and was a beat by $260 million. So why are we seeing this sell-off in Microsoft? Well, there's a couple of different reasons that we have to point to. First off, if we go ahead and jump over to my stock screener real quick, come up here and plug in MSFT and hit enter. One of the things we can see, the free cash flow yield for Microsoft sitting at 1.97%. And this is basically telling us how much free cash flow we get for the price per share that we're buying Microsoft at. So basically what I'm trying to say is Microsoft is not by any means a cheap stock, and I wouldn't expect it to be. This is one of the highest quality companies in the entire world. So leading up to the earnings report, there was no doubt Microsoft had a huge run up over the past year. They were up around 23.51%, and in the past 5 years alone, up nearly 200%. The forward-looking price to earnings was sitting at about 30.56. So yes, it was important to keep in mind this company was trading at a premium valuation, but with that being said, there was a second reason. If we look at the growth of all the different products in Microsoft's portfolio, again, it's pretty phenomenal to look at. There's a lot of double-digit growth that we'll see here. Now, if we look right here, we can see Azure and other cloud services right here. Growth came in at about 29%. Now, what's interesting is Wall Street analysts were projecting about 31% growth, and a lot of people are speculating that this is part of the reason for the sell-off in Microsoft, but this is honestly a pretty silly thing to think about. Yes, Microsoft is competing with Google in this area, and Google is growing pretty rapidly as well, but 29% growth is pretty phenomenal. I don't think I'd ever be disappointed with 29% growth. And I can guarantee you a year from now, this won't even be a talking point. This business segment is still growing very rapidly. And look at all the other areas they're still seeing double-digit growth. We have Microsoft Cloud, 21%, Office commercial products and cloud services, 12%, Office 365 commercial, 13%. We have LinkedIn growing at 10%. And keep in mind, Microsoft bought LinkedIn in 2016 for $26 billion, so they're still seeing really good growth after almost a decade of owning LinkedIn. We can see business segments with 16%, 19%, 21% growth. And then down here we have Xbox content and services at 61% growth. Now you're probably wondering what is up with that? Why was growth so high? This is actually because of the Activision Blizzard acquisition. So I want to dig into the earnings report just a little bit more, but first let's go ahead and jump over to the dividend breakdown sheet, get a general idea of the dividend metrics for Microsoft. We'll come up here and plug in MSFT, and all this data will automatically load in. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now we can see the starting dividend yield for Microsoft is low, sitting at 0.74%, but the dividend growth, free cash flow growth, for a very long time has been very, very good. And that's what makes it such an attractive dividend opportunity if you're a long-term investor. Obviously, if you're someone close to retirement age, looking for immediate dividend income, this probably isn't the best option for you. But look at this. Very low payout ratios, and we can see that free cash flow payout ratio over the past decade has remained in a very healthy range. In 2022, it was as low as 27.84%, and 2023 sitting at about 33.29%. We can see 10% dividend growth over the past decade and 9.68% over the past 5 years. We can see 13% free cash flow growth over the past 5 years. So look at this. We can see free cash flow growing at a rapid rate, and it's easily covering those dividend payments. So for some perspective, dividends paid out in 2023 sitting close to about $20 billion, while free cash flow overall close to about $60 billion. Now, if we take a closer look at the earnings report, we can see the business breakdowns here. Productivity and business processes came in at about $20.3 billion, intelligent cloud $28.5 billion, and more personal computing $15.9 billion. So we can see the overall growth of each of these segments. We have 11%, 19%, and 14% growth. So overall, 15% revenue growth. That's really, really good, especially when you think about how long Microsoft stock has been around. And if you look at the gross margin percentage right here, we can see it came in at about 70%. Now, let's put this into perspective of how the company's done historically speaking with gross margins. You can see, if we look at my profitability spreadsheet, I've already plugged in Microsoft, we can see the 10-year average gross profit ratio sitting at 67.37, and as of 2023, it was sitting at about 68.92%. So gross profit margins are really good, and it's actually inched up even a little bit more, even a little bit better. So this is something to be excited about if you're a Microsoft investor. Now, if we jump over to the 6th slide, we can see some cash return to shareholders. We have $5.6 billion returned in the form of dividends and then $2.8 billion in share repurchases. Again, this company has been buying back stock as well. We can see shares outstanding in 2013 sitting close to about 8.37 billion, and in 2023 all the way down to around 7.4 billion. So it looks like paying out dividends a little more of a high priority for the company, but yes, they are also buying back shares. Like I mentioned just a few moments ago, LinkedIn revenue still coming in pretty good. It's up by about 10%. And then if we come down here, remember the Activision acquisition, Xbox content and services revenue increased 61%, but 58% of this was driven by the Activision acquisition. So that gives you a little more perspective into how they're actually growing. Now, if we jump over to my balance sheet breakdown sheet, we can get kind of an idea of how this acquisition has affected Microsoft. And just off a quick glance, what we can see is Microsoft is very profitable with their ROA and ROE, but they're also drowning in cash. Look at the current ratio over time. We can see, historically speaking, they've never been in a poor cash position. The debt to assets ratio looks good as well. Cash per share seems to be in a good shape. But what we can see is cash and cash equivalents grew all the way to about $34.7 billion as of 2023. Now, if we jump over to Microsoft on Seeking Alpha and look at the balance sheet, scroll down, we can see this has dropped down pretty significantly as of their last report, now sitting at about $18.3 billion. And if we scroll all the way down to look at their total debt, we'll also notice total debt has climbed as well. Right here, we can see it's gone from about $79.4 billion in 2023 to now, with a recent report, $97.8 billion. So total debt has climbed. But again, this really shouldn't be something you're concerned about. It's good to understand how these things are changing, but Microsoft is still in a great position from a balance sheet perspective. Something else that we've been seeing lately is Microsoft is continuing to grow their market share when it comes to being a cloud provider. We can see they've taken a lot of market share from competing companies over the past few years. In fact, out of the companies we see here, only Google and Microsoft have been increasing their market share. So the fact that Microsoft has been selling off after their recent earnings report in reality is a little bit silly if you only look at the results. Now, if you look at the broader market as a whole, maybe that does have something to do with it. There's a lot of uncertainty in the market right now, obviously. But with that being said, Microsoft has multiple qualities that make it one of the highest quality businesses in the entire world. I mean, if we look at a few of those reasons, we already touched on the balance sheet. It looks phenomenal. Look at the earnings per share growth, revenue per share growth, free cash flow per share growth. They're all beautiful charts. But there's a couple of other things that I want to point out. Look at the return on invested capital. Very high quality companies consistently have ROIC of above 20%, and we can see Microsoft has been doing that since 2019, and before that they also had healthy levels of return on invested capital. Look at 2023, ROIC of 27%. Another sign of a quality company is consistently high gross profit margins. Now, there are exceptions to this one like Amazon, but again, look at the consistency with the gross profit ratio over the past decade, and like we saw in the earnings report, it's even better in the most recent quarter. And then finally, something I was actually talking about on Twitter the other day, there's only two companies in the entire world that have a AAA credit rating, and that's Microsoft and Johnson & Johnson. And to put this into perspective, this is a higher credit rating than the United States. This is basically telling us that their 30-year bankruptcy probability is 0.07%. So with all this being said, is Microsoft a good company to consider adding to your portfolio at current prices, especially after the 12.5 to 12.6% sell-off? And to answer that question, let's go ahead and jump into my stock valuation spreadsheet. Again, you can download any of these spreadsheets over on Ticker Data. We'll come up here and plug in MSFT, and this data will load in. Now, the beta for this company is a little bit below 1, meaning you'll see a little less volatility than that of the market. But if we go ahead and jump into Graham's valuation, this will be the first valuation that we look at, and it values a company using Graham's formula, and it's basically a way to see how the company's earnings per share are projected to grow while also taking into account current market conditions. So the first thing we need is our estimated earnings per share average. We can easily bring this in with the ticker data function. We'll use ticker data. We're going to select Microsoft stock here. We want estimated earnings per share average for 2024, and I'll hit enter. And we can see this will come in at 11.86. So I'm going to go just a little bit above analyst expectations and go with 11.9. I've already applied my growth rate projection of 17 and then plugged in Y, which is the current yield on AAA corporate bonds, and that's currently sitting at 5.03. Now, this is quite a bit higher than it has been historically speaking over the past 5 to 10 years, and this will drive down the valuation quite a bit. And as we can see, we come to an intrinsic value of $250 per share. Now, complete disclaimer, if Microsoft was actually trading at $250, I would be buying shares hand over fist. And in fact, a couple years ago, that's exactly what I was doing. If we zoom out just a little bit, we can see Microsoft dipped down to around $220 per share in 2022, and I actually made quite a few videos on how I was buying the stock then. I added more shares around 280, and I actually added my first share in a couple years during this recent dip. Now, if we keep moving forward and look at our discounted cash flow analysis, you can see we're valuing the company based on how much free cash flow they're projected to produce in the future. So moving forward, I'm projecting a free cash flow growth rate of 16%. So we apply that to the future free cash flows, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of about 356.05. Now next we'll look at the multiples valuation, and this is basically a way of seeing how is the market valuing companies that are similar in structure. And obviously when you get to be as big as Microsoft, there's no perfect comparable, but we do have some other big tech companies, some of the big seven like Apple, Amazon, Meta. We can see their price to earnings multiple here, and the average for these companies sitting at about 41.92. So if we apply that same price to earnings multiple to Microsoft, we'd come to an intrinsic value of $407.53, which is pretty much close to what the company is currently trading at. And then finally, we have our dividend discount model, and this values a company based on how much they pay out in dividends and how much that dividend is increasing. So we can see the dividend payouts for Microsoft here, the historical growth rates. Moving forward, I'm projecting a dividend growth rate of 8.25% and a discount rate of 9%, and this gives us a dividend discount model price per share of $433. So if we jump over to the output tab, we can see our four valuations averaged together, and that comes to an intrinsic value of $361.60. Now, some people could argue maybe you should take out Graham's valuation in this scenario, and in that case, it jumps up to about $398.86, which is actually very close to the current trading price. It's only off by about 2%, but with a 10% margin of safety, your acceptable buy price would be about $358.97, meaning now's not necessarily a great time to buy. Now, we have to remember, valuation is very much an art. It's not a science. It doesn't take into account that Microsoft is literally one of the highest quality businesses to ever exist. They have multiple business segments with double-digit growth. They have phenomenal profit margins. They have consistently high levels of return on invested capital. And they're literally one of just two companies with a AAA credit. Rarely do you get an opportunity to buy Microsoft at a discount. And so I'm not arguing that Microsoft is at a discount right now, but if it's trading close to fair value, that's typically one of the best opportunities you're going to get. Now keep in mind, whenever you buy a big tech stock, you have to be able to roll with the big fluctuations you can see in share price. Yes, the beta was below 1, but if we jump over and look at them in the past 5 years, there was times where they were trading as high as $339 and then dropped to around $230. We can see $340 and dropped all the way to around $313. And then again, in the past month alone, they're down over 12.5%. But if you're someone with a long time horizon, you don't have anything to worry about. Focus on buying high quality companies at good valuations, and I think you're going to like the returns that you get. So again, complete transparency, this past month was the first time I added any Microsoft to my portfolio in a couple of years. Now I only bought one share, but I'd love to see it go even lower. But go ahead and let me know what you think of Microsoft stock in the comments down below if you plan on buying or selling. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.